Welcome to the Ontario Mortgage and Real Estate Insights podcast, where we delve into the latest developments and trends affecting the real estate and mortgage industry. I'm your host, Steve Hamoan. As a principal broker at Real Approved Incorporated in Ontario, Canada, and a certified 10X business coach, I bring over 25 years of experience in sales and business development to the table. Together, we'll explore the insights you need to make well-informed decisions in this ever-evolving landscape. In today's episode, we're going to take a closer look at the slow growth in mortgage debt across Canada, as reported by the Canada Mortgage and Housing Corporation. Just released, the Residential Mortgage Industry Report highlights that Canadian residential mortgage debt increased by 3.5% year over year in July 2024, reaching a staggering $2.2 trillion. Now, while this might sound significant, it's important to note that this growth is historically slow. The main reason? Many potential homebuyers have stayed on the sidelines for much of the year. So, what's keeping these homebuyers from jumping into the market? High borrowing costs and elevated home prices have been major deterrents. But there's more to the story. The expectation of lower mortgage rates in the near term, as the Bank of Canada moves forward with policy rate cuts, has also played a role. Prospective homebuyers are waiting for these rates to drop, hoping for more favorable conditions to secure a mortgage. Despite the slow growth, mortgage debt has actually outpaced inflation and could potentially increase further if financing becomes more affordable. Recent outlooks from the Canadian Real Estate Association have already shown an uptick in home sales following each policy rate cut by the Bank of Canada. This suggests that while the current growth rate may be below recent and historical averages, there's potential for acceleration as rates become more favorable. Looking ahead, there's another significant factor to consider: the upcoming wave of mortgage renewals. Approximately 1.2 million fixed-rate mortgages, representing over $300 billion, are up for renewal in 2025. Over 85% of these were originally contracted when the Bank of Canada's policy interest rate was at or below 1%. As these mortgages come up for renewal, many homeowners will face the reality of higher interest rates, coupled with already high household debt levels. This situation is being closely monitored by the financial industry and policymakers. The recent announcement of the new Canadian Mortgage Charter in the 2023 Fall Economic Statement underscores the importance of addressing these challenges. While the mortgage delinquency rate has risen slightly, from 0.17% in the fourth quarter of 2023 to 0.19% in the second quarter of 2024, it still remains below pre-pandemic levels and well under the historic average since 1990. Interestingly, there's been a shift in the type of mortgages being taken out. Based on regulatory filings from chartered banks, the most common reason for a mortgage loan is still to obtain an owner-occupied property. However, since 2019, this share has been decreasing. In the third quarter of 2019, 75% of newly extended mortgages were for owner-occupied properties, but by the third quarter of 2023, that share had fallen to 70%. This decrease has been offset by an increase in mortgages for investment and rental properties. In fact, mortgages for these purposes rose to 17% of total mortgages in the third quarter of 2023, compared to just 13% in the third quarter of 2019. Canadian real estate continues to be viewed as a strong investment, driven by strong market fundamentals and a high demand for rental housing. As we move forward, it's clear that mortgage debt growth remains below average, with shorter mortgage terms remaining popular as home buyers and those renewing mortgages anticipate lower interest rates. The Bank of Canada's consecutive rate cuts since June, including a 50 basis point cut in October, may very well spark an uptick in mortgage activity through the rest of 2024 and into 2025. As we continue to explore the complexities of Canada's housing market, it's crucial to consider the recent investor retreat from the condominium market and its impact on home ownership in the country. According to a report by Reuters, sales of pre-construction condominium projects have plummeted to historic lows, posing a significant threat to the funding required for new construction and exacerbating the ongoing homeownership crisis. Economists and real estate professionals have voiced concerns over the declining sales of proposed 1- and 2-bedroom condos, particularly in major urban areas like Toronto. These pre-construction sales have traditionally been fueled by investors purchasing units with the intent to rent them out. However, the current landscape of high mortgage costs, diminished expectations for capital gains, slower rent increases, and overall market uncertainty has deterred many investors from entering the market. John Pasalis, president of the Toronto-based real estate brokerage Realosophy Realty, highlighted that typical homebuyers are not rushing to invest in small condo units. In an interview with Reuters, he remarked, "If you think moms and dads with strollers are lining up at condo projects to buy 500-square-foot condominiums, they are not." This sentiment underscores the shifting dynamics in the market where investor activity once fueled a construction boom in urban centers. The consequence of this investor pullback is significant. Normally, a threshold of 50% to 70% of units must be sold before lenders are willing to finance new projects. Without achieving these benchmarks, many projects face delays or cancellations, further constraining future housing supply. Robert Hogue, a housing economist at the Royal Bank of Canada, warned that a decrease in pre-sales will likely result in fewer construction starts in the coming months. He stated, "We are not going to balance the market for ownership in the next 4 or 5 years." This suggests that the supply-demand gap could widen, creating additional challenges for prospective homebuyers. In response to these challenges, the Trudeau government has implemented policies aimed at alleviating the housing crisis, such as extending mortgage amortizations to 30 years for first-time buyers and purchasers of newly built homes. However, critics argue that these measures fall short of stimulating new construction or attracting cautious investors who are wary of uncertain returns. Despite 4 rounds of interest rate cuts, the 5-year fixed mortgage rate, which remains the most affordable option, has not decreased enough to make a significant impact on the market. Additionally, attempts to manage population growth through stricter immigration policies may not sufficiently alleviate demand. Robert Hogue noted that the growth rate will likely remain strong regardless of these efforts. The Canada Mortgage and Housing Corporation reported last month that new condominium sales were down by more than half in the first half of 2024 compared to the same period in 2023. This sharp decline is alarming for developers who depend on pre-sales to secure funding for their projects. Aled Abiyorworth, the deputy chief economist at the Canada Mortgage and Housing Corporation, emphasized the difficulties in building large condominium structures in the current market environment. As we continue our discussion on the challenges facing the mortgage market, let's delve into the latest findings from the Canadian Mortgage and Housing Corporation's Fall 2024 Residential Mortgage Industry Report. This report sheds light on a significant issue looming on the horizon: the renewal of 1.2 million mortgages in 2025, with 85% of these expected to face higher interest rates than when they were initially contracted. When these mortgages were first taken out, the Bank of Canada's policy interest rate was at or below 1%. Fast forward to today, and the rate sits at 3.75%. While there's speculation about a potential 50 basis point cut in December, the rates are still unlikely to drop to 2% until at least July 2025, and it's improbable they'll reach the previous low of 1% anytime soon. This means that many homeowners could see their interest rates increase by 1% to 2.25% as they renew their mortgages. The implications of these higher rates are substantial. The Canadian Mortgage and Housing Corporation reports that mortgage delinquencies have been on the rise, although they remain below pre-pandemic levels. The mortgage delinquency rate, which was at a historic low of 0.14% in 2022, climbed to 0.19% in the second quarter of 2024. This rate is expected to increase further through 2025 as homeowners grapple with higher payments. In addition to rising delinquencies, overall mortgage debt has surged, reaching $2.2 trillion in July 2024. This marks a 3.5% increase from the previous year, exacerbating the vulnerability of households already burdened with elevated debt levels. The slower growth in mortgage debt is partly due to potential buyers staying on the sidelines, deterred by high borrowing costs and elevated home prices. However, there's an expectation that lower mortgage rates in the near term could accelerate debt growth. Interestingly, the anticipation of future rate cuts has also influenced mortgage terms. Borrowers are opting for shorter fixed-term mortgages, ranging from 3 to less than 5 years, rather than locking in for the traditional 5-year term. In July 2024, over half of the $43.7 billion in newly extended mortgages by chartered banks fell within this shorter duration. 5-year fixed-rate mortgages accounted for only 12% of new mortgages during the same period. The trend towards shorter terms is also reflected in the decline of variable interest rate mortgages. The share of newly extended mortgages with variable rates fell to 9% in July, down from 20% earlier in the year. This shift is driven by borrowers' expectations of further rate cuts from the Bank of Canada, which would make variable rates less attractive in the short term. Today, we're diving into the latest insights from the Canada Mortgage and Housing Corporation, which has issued a warning about the potential rise in mortgage delinquencies in 2025. As we look ahead, a significant number of Canadian homeowners are bracing for a wave of mortgage renewals, even as the Bank of Canada continues to lower its benchmark interest rate. The Canada Mortgage and Housing Corporation has reported that the mortgage delinquency rate, which measures the proportion of Canadians who have missed payments on their mortgage for more than 90 days, has been on the rise. By the end of June 2024, the delinquency rate had increased slightly to around 0.192%, up from the all-time low of 0.14% recorded in 2022 and 0.17% at the end of 2023. While this rate remains below the 0.28% seen in 2019, the upward trend is concerning. According to Tanya Barasa Ochoa, the Deputy Chief Economist at the Canada Mortgage and Housing Corporation, this sticky upwards trend is expected to continue, potentially reaching pre-pandemic levels by the end of 2024 or early 2025. Barasa Ochoa explained that financial pressure is mounting on homeowners, with many Canadians in a fragile financial state due to the higher cost of living, elevated interest rates, and sizable mortgages. Beyond mortgages, there are signs of financial stress in other areas as well. The delinquency rates for auto loans, credit cards, and lines of credit have all seen increases in the second quarter of 2024. The delinquency rate for auto loans, for instance, rose significantly to 2.42% from 2.11% in the previous quarter. The Canada Mortgage and Housing Corporation suggests that these credit product delinquencies could be leading indicators of further increases in mortgage delinquencies as financial strain spreads. Barasa Ochoa pointed out that Canadian households typically prioritize their mortgage payments above all else, making it the last domino to fall when budgets tighten. However, with 1.2 million fixed-rate mortgages up for renewal in 2025, most of which were originally taken when the central bank policy rate was at or below 1%, many homeowners are facing the prospect of renewing at significantly higher interest rates. Despite the Bank of Canada's interest rate cuts, which have lowered its policy rate by 1.25 percentage points since June, the current rate sits at 3.75%. This means that over 1 million mortgage consumers will be renewing their loans at these higher rates next year. The Canada Mortgage and Housing Corporation estimates that the average homeowner renewing in 2025 will see their monthly payments increase by about 30%. Projected future rate cuts are already priced into the market, meaning the current rates might be the lowest we'll see for this cycle. However, the Canada Mortgage and Housing Corporation predicts that housing activity will pick up in 2025, supported by the Bank of Canada's rate cuts and proposed changes to expand insured mortgage availability and extend amortizations to 30 years. A tighter housing market could help cushion distressed homeowners by providing them with the option to sell their homes more readily if needed. Barasa Ochoa also noted that further interest rate cuts could stimulate the broader economy, potentially tightening the labor market. Improved employment prospects would enable Canadians to better manage higher mortgage payments. Conversely, any economic shocks that weaken the jobs market could lead to a higher than anticipated rise in mortgage delinquencies and defaults. It's crucial to recognize that higher home prices over recent years have resulted in larger mortgages, placing households in a more vulnerable financial position. While the upcoming policy rate cuts are expected to inject some momentum into the economy, it's important to remain aware of the increased financial fragility among Canadian households. As we wrap up today's episode, let's take a moment to consider the analysis from TD Economics regarding the upcoming mortgage renewal surge in 2025. This analysis offers a different perspective on the situation, countering the widespread anxiety about rising interest rates and the calls for aggressive rate cuts. According to TD economists Beata Caranci and Maria Solovieva, approximately 1 in 4 Canadian homeowners set for mortgage renewal in 2025 will actually experience lower reset rates than anticipated. This is an interesting development, considering the general expectation that rates would continue to rise. The key here lies in the strategic decisions made by some homeowners who opted for shorter mortgage terms. These homeowners took advantage of historically low rates and anticipated further decreases by the time their renewals came around. Their foresight seems to have paid off, as current 5-year fixed rates have decreased to between 4.0% and 4.7%, compared to the previous averages of 5.8% to 6.9%. While the majority of those renewing will face higher rates than their original contracts, TD's report suggests that the increases may be manageable. Since 2020, both home prices and wages have risen significantly, providing many homeowners with greater equity and financial flexibility. This equity could allow them to extend their amortization periods, easing the burden of higher payments. For those with variable rate mortgages, the 125 basis points in rate cuts implemented so far have already provided some relief, translating into savings of approximately $370 per month on a $500,000 mortgage. Additionally, homeowners whose payments do not immediately adjust with rate changes are likely to see benefits at renewal, either through lower payments or shorter loan terms. The report also highlights the proactive steps many borrowers have taken, such as increasing their payments to reduce their amortization periods by an average of 1 year. Furthermore, Canada's strict mortgage stress test has created a safety buffer for homeowners, ensuring they qualify at rates higher than their contract rates, which has helped many maintain financial stability even as rates fluctuate. TD Economics cautions against the allure of large rate cuts, warning that they could have unintended consequences. A rapid decline in rates might fuel consumer spending and reignite the housing market, which could lead to higher household debt and renewed affordability issues. Moreover, significant rate cuts could widen the interest rate gap between Canada and the United States, potentially weakening the Canadian dollar and affecting the country's purchasing power abroad. As we consider these insights, it's clear that while rate cuts may provide some short-term relief, they must be carefully balanced against the long-term economic implications. As always, it's crucial to stay informed and consider the broader picture when making financial decisions. That wraps up today's episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found our discussion insightful and helpful as you navigate the ever-changing landscape of the real estate and mortgage industry. Thank you for tuning in, and I look forward to our next episode. Until then, take care and stay informed.